Welcome to Markets Now. I'm Michelle. Work with Brian Grady, a pro farmer, hired in the livestock grain, sitting back here. A little consolidation today, Brian. Just some profit taking, you think, here, because we had run up into a little bit of chart resistance, hadn't we?
Yeah, I do. I was encouraged by the price action in the grain and soy markets last week, and so to see a little bit of a pause, probably not too surprising, especially given that we're on a shortened week with the markets closed for Good Friday on Friday, and so we'll see where we go forward. But we probably have done the easiest of the climb here with the price action last week, and it's going to be a little bit harder with some headwinds as we move forward.
Technically, we ran up into resistance on the corn, May, right up in that 62% retracement level, though, right?
Absolutely. So we saw the flush in nearby futures below 450 attracted buyer interest, and then now we're into the chart resistance overhead, and so we have to clear those levels. If we do, then I think you see more fund money come into the long side of the market in the short term. But it's probably not going to be an easy climb. Like I said, I think that the easier work was done last week to the upside, and it'll be tougher moving forward.
Absolutely. Weather, were we taking out a little weather premium, at least in the wheat market?
Yeah, so this time of year, obviously, rains mean something, especially to the winter wheat crop, and especially in the HRW areas that are dry. So if they do get those rains that are in the forecast, it's going to help the wheat, and that put pressure on wheat futures on Monday, and so we'll see moving forward how that develops. Some of the forecasters aren't as optimistic for that dry southwestern areas of the plains, but any rains at this point in time will be price negative for the market, and are seen as beneficial to the wheat yields moving forward.
So, what are you hearing in terms of planting progress so far on corn?
The concern I think is that Ohio River Valley, Tennessee River Valley, Lower Mississippi River Valley, where we saw some flooding previously, and they should be rolling along pretty actively on corn planting in those areas. So to get to the 95.3 million acres that USDA estimated as of March, we can't have too many hiccups because that's a big jump. So we'll probably see some of those acres switch over eventually to soybeans and other crops. And so in all likelihood, the March number was probably the high water mark for corn plantings, and we'll move down some from there. And soybeans might have been the low water mark and move up from there. But we'll have to see as we move forward. It's still too early to get overly concerned, but that is the one area to watch probably moving forward.
Gotcha. Beyond today's setback in the grains, we had higher weekly closes and everything last week. Do you think the market has already traded the worst case scenario in terms of tariffs and trade?
I do actually. You never know what's going to happen, but I'll just use soybeans as an example. You get to a point, and we weren't going to move a lot of soybeans into China anyway, and then you get President Trump and China exchanging the increases in the tariffs, and at some point in time, it doesn't matter anymore. At that point, it's just numbers being thrown out there, and the market realizes, well, the exports weren't going to happen anyway, so it doesn't matter what the tariffs level are.
I have to ask you, the pullback that we've had in the dollar, how much does it offset some of the universal tariffs even that we're seeing?
Well, it does to some degree, and the currencies I think is the most fascinating and critical thing as we move forward with all the current with all the tariffs talk, and so historically, pullbacks in the dollar matter. But they matter more on a day-to-day basis for a reason for money to flow into the long side, the short side, come out of the market on either side of the market than they do actual exports. There's a lag factor involved, and it's roughly around 6 months typically before you see price action in the currency have an impact on the actual exports. And so day to day and short term basis, it means more to the futures than it does to the actual active trade.
Yeah. So, from a money flow perspective, since you brought that up, where do you think the managed money is going to go now, especially since we had shuffling of the deck chairs with what happened with the equity sector and everything else now?
Yeah, absolutely. So equities, the old adage is that money comes out of the stock market and it goes into commodities and something such and forth. But I don't think we're in an environment where the asset classes where they want to be, the investor wants to be long. and it's too much risk right now. So risk aversion, but bigger risk aversion in the stock market than there is in the grains right now, and so we should see calmer waters, so to speak, than what the equity markets are seeing. Um, I, I just don't feel like that the funds want to be long, and if they are long, that they don't want to be long much. So corn is probably the most friendly at this point in time. Soybeans kind of neutral, wheat negative, I'll say, just because of the seasonalities with the winter wheat harvest approaching.
Yeah, but we've been, I think, really resilient in both the corn and soybean markets with all the negative news that we've thrown at it. The soybeans, I wonder, with what's going on with China buying all the Brazilian beans, the basis levels improving there, how much is that helping soybeans? Or is the market looking forward at maybe biofuels policy changing and being supportive?
Yeah, so that's an interesting question because there's a lot coming at the marketplace right now. Typically, this time of year, you're trying to zero in on where the demand is here domestically, where we're going to end up on ending stocks. You're focusing on wrapping up the soybean crop in South America. Brazil's safrinha corn crop is just in the beginning stages down there. So you normally have all that. And now you throw on top of it all the trade uncertainty and everything. And so there's a lot coming at the marketplace, not only on a week to week basis, but day to day and sometimes even hourly in the terms of the tariffs and trade stuff. And so we are going to see some back and forth movement, I think, and a lot of volatility, so to speak, within the price structure in the grain and soy markets.
Yeah, with the risk off that sometimes comes in, do you think that's going to cap the rallies? Is that going to leave us unable to get above $5 on corn or $11 on beans, or are those targets still achievable?
I think they're achievable. So they're possible. I don't think necessarily probable, just because, like I said, not an environment where you want to be aggressively long markets, and so we could see some money continue to flow into the long side and push us a little bit higher. I still think you have to be cognizant of the fact that there are headwinds. And you probably need to take advantage of selling strength and focus on that. And if you get a big price break, we've seen buyers come in under the market. Don't panic a whole lot, and just kind of keep the big picture in mind.
Some recovery in the cattle market as the stock market is recovered. If the S&P can continue to recover, will cattle futures as well or not?
Well, so the meat markets, cattle and hogs, they took the all the tariffs and trade stuff and risk aversion much more uh, bruntly than what the grains did, and I think you'll continue to see that. And the reason is demand and recessionary concerns with all the trade stuff and the tariffs and everything, and so what did we hear last week? We heard stagflation a lot. We heard recession a lot. We heard inflation a lot, and those types of things. Those words are not conducive to an environment where the trader is settled on the meat side of things, with it being so demand driven. And so I think that uncertainty is probably going to keep us the cattle futures well below the cash market. The hog futures are trading at premiums to the cash index as they typically would, but those premiums are modest compared to what they normally would be at this time of year.
So do you think the funds keep liquidating, especially in the cattle?
Yeah, I think there is risk of that. I think that the risk now is that if you do see a move up, that you see fresh seller interest come into the marketplace in the terms of long liquidation, especially in the cattle. And if you look back to 2024, everybody knew about the bullish supply side of that market. Really, what pushed us to record highs in 2024, and then again early here this year, is the demand side of the market. And so, if we see demand falter, or even if we see have concerns with demand faltering, then you're going to create an environment where the fund doesn't want to be as long as they normally would, and that type of thing, and then you do run the risk of long liquidation.
Yeah, and the funds have already liquidated a huge chunk in the hogs. Do you think that market, even though cash and you said futures are pretty close together, does that market have a little bit more recession proof to it?
The hog market and pork does have more is more recession proof than what cattle and beef are. But with that said, I think that it probably just limits the upside. To be honest with you, we should be strengthening seasonally, and we probably take a cautious approach. And we're really cautious right now. Both cattle and hogs, I would say, traders have a pessimistic viewpoint just based on the cash and futures relationships there.
No doubt. All right. Thanks for joining us, Brian Grady with Pro Farmer. That is Markets Now.